Good evening. I'm Mike Knetter, and welcome to the UW Now, where we bring you experts from the Wisconsin community discussing timely and important topics. Tonight, we'll discuss inflation, the Fed, interest rates, and the economic and financial outlook. Of course, these subjects are all over the media these days, so it's fair to ask, why should you listen to our views? Well, let me give you two reasons. First, we have extremely knowledgeable guests on the subjects we cover. They've spent their entire careers studying these issues, and you will soon find out. Second, we don't select our guests for some predetermined point of view, and we're not trying to sell you anything, and our guests have no conflict of interest. They're not trying to sell you anything either. This is not true for most media outlets and their guests, who you might see. So we come to you with knowledgeable and unbiased experts, but that doesn't mean they have perfect foresight, so buyer beware. All right. Last month, the Federal Reserve made its largest interest rate hike in 28 years in an effort to curb inflation. There's a lively debate about whether this ongoing inflation is caused more by pandemic and war-related supply constraints or by excess demand caused by overly expansionary fiscal and monetary policies during the pandemic. Fed rate hikes might eliminate excess demand, but they won't fix supply shortages. And in fact, they could reduce the incentives to do so. How are inflation and interest rate hikes changing the forecasts for US and global economic growth? Is a recession imminent? And what impact will all this have on the stock market and the labor market? And how can we, as consumers and households, adapt to these circumstances? Tonight, we've got three UW experts joining us to discuss inflation and its consequences for consumers and investors. J. Michael Collins is the Fetzer Family Chair in Consumer and Personal Finance and the Faculty Director of the Center for Financial Security here at UW-Madison. Paul Leff is the co-founder of Perry Capital, where he served as Chief Investment Officer for 25 years. Perry Capital was a wildly successful New York-based hedge fund. Paul is also a former member of the Wisconsin Foundation Alumni Association Board and a double badger. And leading us off tonight will be Kim Ruhl, the Kurt and Sue Culver Professor of Economics and co-director of the Center for Research on the Wisconsin Economy. I'd like to welcome all three of you, especially Paul, a first-time guest, and our repeat offenders, Michael and Kim, are back with us at their usual high wage rate. So we really appreciate your time on a summer evening. Thanks for being here. All right, so leading us off, as noted, Kim Ruhl. His research focuses on international economics, models of firm heterogeneity, and national income accounting. He is currently a research associate at the National Bureau of Economic Research and a special sworn employee of the U.S. Bureau of Economic Analysis, where he studies the ways that multinational firms produce and sell goods and services around the world. I might ask you how you think that's changing these days, because there's been some geopolitical convulsions around the world. As he often does for our program, tonight Professor Ruhl's assignment is set the context with a tour through the data shaping our current economic environment and some thoughts about the months ahead. So Kim, please take it away.
Great, thanks, Mike. Okay, wonderful. So thanks for having me. We can go to the next slide and get started. Okay, so I want to, as Mike said, I want to give you a little bit of just an overview of what's going on, and then let Paul and Michael talk some more about some of the responses to it. I'll just start with just some basics. It's hard to get away from being a teacher. We hear a lot about words like inflation. I want to just be a little bit careful about kind of why people care so much about inflation, and kind of how do we actually go about measuring it. So when someone says the inflation rate is 6%, I want to be a little careful about exactly what that means. Then we'll kind of fly through some of the inflation data and sort of talk about why people say things like it's historically high, what that means, and kind of really put that into perspective. And then I'll just say a few words about the Federal Reserve's response, which is kind of what's been the focus of a lot of what's gone on lately and why people might be worried about recessions. So that's kind of a roadmap of today's little talk. Next slide, please. Okay, so just review why inflation is something that we worry about, because in some ways you can think about an increase in the price level if everybody's wages go up at the same rate as the price level, shouldn't really make a difference. And that's because the reason we care about money, the reason why we go to work, is not to earn dollar bills, right? A dollar bill or $20 bill in this case isn't terribly useful. I can't eat a dollar bill. It doesn't provide me entertainment. I can't watch a Badger football game on a $20 bill, but I can trade it for the things that I like: cheeseburgers, football tickets, beers, things like that. And so what changes in prices do are change the relative value of those two things, for example. So I've got just a simple example here. Suppose I'm earning $20 an hour to work and lunch for two costs $20, let's say. So that says I'm trading a $20 bill somewhere, but who cares? What I really care about is I'm trading an hour of my labor effort, an hour of the skill embodied in my work, an hour of my time for enough purchasing power to go out and take my wife out for lunch. Right? And so I think about at $20 an hour for a wage, $20 for lunch. I'm basically trading an hour of work for lunch for two people. Now, what happens when there's inflation? When the price of lunch goes up and my wage doesn't. So if we have a 10% inflation, not matched by a 10% change in the wage, well, then that same hour of work with those skill embodied in it and the effort embodied in it now only pays for 90% of that lunch, right? So I still have to work the same amount of time, but now I get less for my for my effort, right? So maybe my wife and I have to split an order of fries, which might be a good idea anyway. But that's the idea when you think about lowering our purchasing power is the money we have, your savings now can buy you less, and our work buys you less. That's where real kind of quality of life issues start to show up. And so that's kind of why people are concerned about inflation and want to keep an eye on it. Next slide, please. So then the question is, what do I mean by inflation? So I just sort of said, well, the price of lunch goes up by 10%, but it's a bit more than that. Right? It's not the price of a single good going up, right? It's a price of when I think about the average price of goods going up all, at the same time. So if all prices tend to be going up, we think about that as inflation. If it's a price that's going up in a particular good, but the rest of goods aren't the price of other goods aren't growing as fast, we don't think about that as inflation. If it's the price of goods in a particular part of the country, there's a hurricane in Louisiana and prices kind of spike there, we don't think about that as inflation. That's a localized idea. We think about inflation as being an increase in the general price level, what it costs to sort of be alive in a country. So the way we measure that is through, I'm going to walk you through one of the ways. There's several ways to do it, but the consumer price index is a common thing that you'll hear quoted and talked about. And so think about that consumer price index as the government goes out and surveys a whole lot of people and asks them, what do they buy in an average month? So, you might pay rent, buy some gasoline, have a car payment, go out to eat, watch a movie, something like that, and kind of construct an average basket of goods and services that people buy. Okay, and so the surveys that are being used right now are measuring people's spending habits in 2019 and 2020. So they're constructing what an average person spends money on. And then every month they send people out to collect prices on that basket of goods. And so then that's a measure of the price level of the economy. How much does it cost to be an average person buying an average basket of goods in it? So then the inflation rate is just the change in the price level. It's literally the growth rate of the CPI. And so that inflation rate is attempting to tell us how much more expensive it's getting, month over month or year over year, in order to kind of live the average US lifestyle. Next slide, please. So here's what that looks like. So this is CPI inflation. So this is the growth rate of the price of that basket of goods. And a couple of things probably jump out at you. So the first thing that at least jumps out at me when I look at this is that in the 1970s and early 1980s, the inflation rate was very high by US standards, 15%. Right? So that says if I held on to that $20 bill for a year, I'd have lost 15% of its purchasing power. I get 15% less stuff with that dollar bill. Or if my wage didn't grow by 15%, my labor is now worth 15% less in terms of the things that I want that kind of make me happy. Then coming out of the pretty bad recessions in 1980 and 81, which were sort of done on purpose by the Federal Reserve, and we'll talk about that in a minute, to exactly bring down the rate of inflation. Inflation stays somewhere around 2 and 2.5% for most of the 90s and the 2000s. And then we see at the very end, starting in about early 2021, and when that's going to be an important sort of date, we see inflation now has risen to rates that it really hasn't been at since the early 1980s. So that's the sense in which, if you're watching the news or reading the Wall Street Journal and they say inflation is historic, that's what they're talking about. We haven't seen in the United States inflation rates like this since the 1980s. Next slide, please. So now I'm going to zoom in a bit. So now I'm going to zoom in and just look at the last 12 years of the inflation rate. So same data as before, just looking at a shorter version. And I want to kind of show you two things in this figure. Again, things that you might have heard about or people talk about and might have wondered why we do things the way we do. So I've plotted two lines here now. The first one, that red line, is the CPI we just talked about, that basket of goods that the pricing. And then the black line is the same CPI, but where we remove food and we remove energy out of those things. Now, your first response might be, why would we want to remove food and energy? Those are extremely important things to most people, and they certainly are. And so that's not why we're getting rid of them, because we don't care about their prices. We remove them sometimes and look at the CPI less food and energy, a measure of inflation without food and energy prices, because they're pretty volatile. So if you look at the red line versus the black line, the red line kind of moves around a lot. Right? Energy prices move around a lot. Food prices can move around a lot. And that can give us between, at any 1 month or a couple of months, might give us sort of a distorted view of the long run inflation. See, that black line is actually pretty steady, even though there's some wiggles around it in the red line, because energy prices kind of move around and food prices move around. So that's why you'll often hear the Fed talk about they're looking at CPIs or looking at inflation without food or energy, because they're looking for something that doesn't have quite as much noise in it. They're trying to figure out something about the long run situation. Then by looking at the difference between these two, so now if we focus on the right hand side of that figure, you can see the red line is higher than the black line right now, meaning that part of what's driving the gap basically between those two, what's driving that difference in inflation rates is higher oil prices, higher food prices, and so when we look at what's going on now, energy and food prices are causing more inflation than before. To that end, though, it's worth now thinking about the timing of what's going on in inflation if we want to try to understand what's going on. And so I've kind of marked two dates on this figure. So the first one to the left that says vaccines, I've drawn that line, kind of in March or April of 2021. So that's kind of as vaccines are rolling out sort of widely in the United States. It's when people are starting to kind of come out of their houses again. They want to buy stuff. They want to start going on vacations. They want to get on airplanes. And we see that's really when inflation starts to pick up. The second line I've marked is I've marked that now as as basically February 2022. Oil prices start to move a lot towards the end of February 2022. But if you think the timing, people understood there was going to be a conflict in Ukraine earlier than that, then maybe some of this was happening afterwards. But a lot of inflation is already happening before the Russian conflict. I'm not saying the Russian conflict's not important, but it is sort of important to note that there was plenty of inflation happening before the Russia-Ukraine conflict. Okay, next slide, please. So now just a bit more detail. So I mentioned that inflation is something that kind of happens everywhere. This is just kind of showing you that. So the red line is the national inflation rate that we've talked about. The black line is if we just look at the East, North, Central, Midwest. So that includes Wisconsin and Minnesota, Illinois, places like that. And those two track each other pretty closely. In most of the United States, all of these prices are sort of tracking together in terms of their growth. Next slide, please. Okay, so then thinking about inside the CPI, inside this basket of goods, different types of goods might be growing at different rates. So here, again, the red line is the all item CPI, the sort of headline CPI we're used to talking about. And now the black line there is the price, the inflation rate for transportation. So the numbers in parentheses, that's how important those goods are in that basket of goods. So that's 18% of spending in a month is on transportation. And you see since about April of 2021, the inflation rate has been about 20%. Right? So it does, don't misunderstand this figure to think that like prices are stabilizing. What that says is prices are growing at about 20% a year right now. So they're negative in early 2020 as people stopped going places. So the price of cars, insurance, fuel all sort of fell. But then since basically, again, notice the timing of this. This is early 2021 as vaccines roll out, transportation becomes incredibly expensive. The green line is food. Food makes up about 14% of spending. That includes both food at home and food outside of the home. And you see that starts to pick up a bit later compared to transportation. And now, the inflation rate in food is more than 10%, so higher than average inflation. So those are two sort of sectors that have been we've seen a lot of increases in prices. Next slide, please. Oops, thank you. And then here's just here's two of the subcategories that we haven't seen a lot of problems with. So the purple line again is that's 8.5% of typical spending on medical care. That includes pharmaceuticals and going to the doctor and things like that. There we see inflation is actually lower than the average. And then the blue line, apparel, is kind of interesting. Apparel prices are falling during the lockdown. Nobody has any place to go, so people stop buying clothes and shoes. As things start to open back up again, people begin to buy clothes and shoes again, and the inflation rate is not quite 5% right now. So those are sort of industries that are inflating less quickly. The big industry, or the big sector that I've left out of this is housing. So that includes rents, that includes owner-occupied housing, buying furniture, repairing your house, all of those things. That makes up about 40% of spending. And that more or less tracks the red line. So I didn't include it because it pretty much looks like the red line because it's one of the most important pieces of that. Okay, next slide. So the last thing I just want to touch on is, where's this inflation come from? It's pretty boring in some sense from an economist point of view. It's just demand and supply, which is sort of our answer for everything. The demand side, we coop everybody up for a year. There's no place to spend money. They're saving it. Government stimulus checks, more generous than usual unemployment benefits, low interest rates, high returns in stock markets. People have a lot of savings coming out of COVID, and they want to spend it. So we've got people who want to spend money on one side, including the government, who also wants to spend money. And then we have supply, and we've had supply issues that come from many places, not the least of which are tight labor markets. I was on a UW Now a year ago. Basically, we were talking about how the $15 minimum wage would be a huge problem. This morning, I drove past the Culvers on Mineral Point Road. They're hiring adults at $19 an hour right now. Supply chain disruptions, including supply chain disruptions coming from COVID shutdowns still in China, as well as shipping and even domestic disruptions, and then, of course, the war. So the Fed can't really do a lot about supply. It doesn't really have tools to do that. And so it uses the tool that it has, interest rates, to try to kind of dampen demand, get people to spend less. So next slide, please. And that's what we see here. So again, if you look near 1980, you see interest rates are very high there. And that's the Fed trying to increase interest rates to lower demand and bring down the high inflation rates that we saw earlier that were happening in the early 1980s. Again, if we look now towards the end of the period here, we see the beginning of interest rate hikes on the Fed's part in order to try to tamp down demand in a hope to then decrease the rate of inflation. So last slide, please. So if the Fed is increasing interest rates, what can we expect for the future? Most likely a recession. The Atlanta Fed's GDP nowcast already has says that GDP is shrinking right now. How bad of a recession, I guess, will be the question. That will depend a lot on inflation. The Fed is going to likely let up on interest rates as soon as they think inflation is falling. That recession, the Fed is already sort of, their forecast, not mine, is forecasting another 1.5% increases in interest rates over this following year, and another 0.5% by the end of 2023. Again, lowering demand, particularly for durable goods, which tend to be bought on loan. Benefits of a recession, we could see a reset of labor markets, so kind of a normalization again of that, and should help normalize supply chains, but we'll have to wait and see. Thank you.
As always, thank you, Kim. That is a great setup for our conversation tonight. Next, Paul Leff will give us the investor perspective. As noted earlier, Leff co-founded Perry Capital, a hedge fund where he served as partner and chief investment officer for 26 years before starting a family office business. Earlier in his career, he worked as a principal and portfolio manager at the Harvard Management Company, which manages the Harvard University Endowment. He is also a co-owner of the Las Vegas Raiders, and I know we have some audience members tuning in from Las Vegas. Maybe you can share a bit about whether there's going to be inflation in Raiders tickets prices. Paul graduated with undergraduate degrees in both economics and finance from the UW, and has an MS degree in finance from the Wisconsin School of Business. He is a former Wisconsin Foundation and Alumni Association board member, and has been an instructor for 7 years for the Applied Equity Markets and Research class at the Wisconsin School of Business. He also co-chaired the Wisconsin Eastern Alumni Scholarship Fund, which provides academic scholarships to disadvantaged students from New York City who wish to attend UW-Madison. Paul, thanks for joining us tonight. We had a chance to talk a little bit about your thoughts earlier, and I'm anxious to have you share them with our audience because they're an interesting take on causality and what's driving what in our world today. So, Paul, take it away.
Thank you, Mike. It's good to be with you all. So I'm going to describe as an investor, and I call myself a value investor. So I'm going to kind of go through my thoughts about how we look at the environment today, which is very different than the environment that we were in 2020 after the pandemic sort of bloomed in 2021. So when I describe what a value investor does, it's very simple. A value investor looks to buy securities at a big discount to fair value, and the analysis for a value investor is to examine. It's almost in reverse. It's how much can I lose in each individual investment, and when the amount of loss is modest relative to what can be gained, then a value investor becomes very interested. So those places where you can lose a little and make much more than you can lose, they tend to exist in places that investors don't like. They're in securities that investors have walked away from or dumped, and in many cases they're in securities that have performed very poorly. But generally the characteristic is that essentially you want to buy $1 worth of value for 50 cents. And you have to have some intellectual honesty about your analysis about how much hard value is in any particular security, so that you don't sort of fool yourself into thinking you're getting something that's really inexpensive. So you're looking at really sort of hard asset values in the securities that a value investor invests in. So if I were to describe 2020, especially starting in like April into 2021, that was like a fantasy land for investors. It may have been the biggest speculative bubble that I've ever seen. You had runaway prices in technology companies. Many of them were profitless technology companies. You had obviously a very big boom and now a bust in the crypto space. And then there were busts in other spaces, in the SPAC space, which was a big space. It was companies that were raising blind pools of capital, and investors were speculating that those blind pools were going to be converted into very attractive deals where the securities would perform very well. So, and then lastly, you also had, of course, the meme stock phenomena, where you had some companies that caught the fancy of a few investors. In many cases, those companies really had very bleak futures, and the stocks just went on a meteoric rise, and in many cases have now had a meteoric plummet back to earth. So that was an environment that does occur seemingly about every 15 years or so. And I believe that environment is over and will not return anytime soon. So one of the interesting exercises that anybody could do is you could probably look on the internet for a discounted cash flow model. If you take a company that doesn't earn very much money, but is expected to hopefully going to earn lots of money in the future, maybe in the 5 to 10 year time frame, or maybe even longer, and you take that security and you change one variable in the equation. So if essentially securities are discounted. You're discounting the cash flow year after year after year. And in stocks, you could discount that forever. I mean, a stock, if a company is going to last for a long time, you have a series of cash flows going out for a very long time. But if there is no cash flow until year 5 or year 10, if you just simply change the discount rate by 1% or 2% in a company that doesn't earn much money and trades for a very, very high valuation, you will have a dramatic difference in the present value of that security. So inflation, an inflationary environment where interest rates are reflecting some expectation of future inflation, and where interest rates went from 0 and now are moving up, that really impacts technology companies, especially ones that don't earn much money. And investors had grown very fond of these companies, I think largely because some of the profitless technology companies in the past sort of 5 to 10 years have become very successful investments. The two that come to mind would be Amazon, which earned very little money, but had a tremendous business model for generating revenues, and then ultimately started to earn lots of money, especially in Amazon Web Services. So they took a company that earned very little money and then ultimately did earn a lot of money, and investors rewarded them early on for their growth in revenues. And then the second company is Tesla. Tesla, which earned very little money or lost lots of money in the early days, but had a product that caught the fancy of investors, a revolutionary product. And so those two companies, I think, were very important in terms of like the growth of profitless technology companies in the hope that some of those would become Amazon and Tesla. So I bring those up just because I think the inflationary environment is going to make it very much more difficult for those type of companies to be successful going forward. I'm sure there will be some companies that will go from profitless to becoming very, very profitable. But as a group, those companies have been punished pretty severely in the market. And I would say if you took an approach where you just bought them all, even though they're on average probably down 60%, I don't think that would be a successful investment strategy in an environment where we are experiencing some inflation. So what is going to be attractive to value investors? So as a value investor, you know, it's really an observational approach to investing. You observe the prices of securities, you observe what is going on in the economy right now, and you try to find bargains where the security is trading at a cheap enough price that you recognize there's a range of macro outcomes for the economy, and you try to buy the security so that most outcomes would give you a successful investment. So obviously we're all observing that inflation is very high. I have no idea whether inflation will be sustained at such a high level, but the interest rate environment has reflected to some degree that there is a view that inflation will remain high. We're observing that the Fed is putting up a very tough battle right now and is taking the threat of inflation very seriously. So with the Fed likely to raise rates over the next couple quarters pretty aggressively, I mean, that's a very difficult environment. We observe that the geopolitical environment is very unstable and could even be further destabilized by certain geopolitical events. And then, of course, we're observing that labor shortages, along with very low unemployment, are creating rises in wage rates. But the good news is that security prices have come down. The S&P is down almost 20% this year. Many assets are down even more. So for a value investor, as security prices continue to come down, more and more assets, more and more financial assets become as we roll forward and some of these macro factors play out, if the markets continue to be choppy, value investors get very excited and will have a lot of opportunities to buy securities at big discounts to asset value. These are very confusing times to be an investor overall. And I try to, what I try to do is to try to take like a view that I know what I'm interested in buying today could be lower in 3 months or 6 months or 9 months. But I'm trying to position myself that over the next 2 to 3 years, that the securities that I own, I'm going to have a high degree of confidence that over like a two-year time frame, that I'm buying things at very inexpensive prices and can do well. Lastly, I just want to mention that there is the way most investors think is that they want to forecast the economy and then position themselves accordingly. They want to say, I think inflation is going to be high, and there are several macro factors that are going to hinder the economy, and therefore that will inform my view of where the market is going to be. I think what's happened in our society over the past sort of 15 to 20 years is that the relationship between the market and the economy has actually switched. The market is such a big part of the economy that if I were to want to forecast the economy, the single most important variable I want to know is what's going on in the financial markets. Are the financial markets healthy or not healthy? And that will tell me a lot about what's happening in the economy. So when you think about it that way, it becomes actually more confusing to try to study the economy, which I think kind of helps me as a value investor to recognize how difficult it is to forecast the economy. But it's not difficult to observe when there are certain security prices that are very interesting and are trading at a very cheap level, and recognize that there's a wide range of outcomes for the economy. And I'm just trying to position myself to capture as much of the distribution of outcomes as possible where I won't get hurt too badly if everything turns up to be a lemon. I also recognize that this fight in inflation, I guess overall, I do believe that the Fed can win the fight. I think it's not a lost cause that the Fed can win the fight. I do believe that the fight likely involves a recession in our future, maybe our present, as the Fed continues to fight inflation. But I think one thing that is helping the fight is the fact that the dollar is very strong. That's really going to help the Fed's job, and we'll see where that goes.
Thank you, Paul. I'm sure people are going to be asking which stocks you're buying for that 2-year return you're looking for, but I'll let them ask. Up next tonight, we've got J. Michael Collins, the Fetzer Family Chair in Consumer and Personal Finance in the School of Human Ecology. He's also the faculty director of the Center for Financial Security, professor in the Follette School of Public Affairs, and an affiliate at the Institute for Research on Poverty and the Center for Demography and Ecology. Collins studies consumer decision-making in the financial marketplace, including the role of public policy in influencing credit, savings, and investment choices. He founded Policy Lab Consulting Group, a research consulting firm working with national foundations and government agencies, and co-founded Spring 4, an online database for mortgage servicers and counselors. Michael, tell us how households are going to deal with all this.
Thanks, Mike. I feel like every time I'm on this particular show, we talk about something pessimistic about what's going on with families and the economy. So I'm glad to continue that trend here today. So hopefully this builds on what we've heard so far, but I'm going to focus now in on specifically the issues for consumers and for families. And so, as we think about the impact of inflation, we hear these numbers thrown around, 5%, 6%, 8%, whatever it might be. But for working families, what really matters and what it comes down to mostly is fuel and food. How much does it cost to fill the tank, and how much does basic, the grocery bill cost, and how much do those sort of expenses that they have to spend every week squeeze the rest of their budget. So we've got lots of reasons to be optimistic about the labor market right now. Unemployment's really low. Most people who want to get a job can get a job, and they have a lot more say over when and how they work. We saw that last year with the data in the state of Wisconsin. The wages were up about 5%, which is great. We haven't seen really strong increases in wages in quite a long time. That's about $60 a week. So that's great. I think there's a lot of positivity in terms of where workers are today. But, the price at one point in time, the price of gas in a pretty short period of time went from $2.50 to $5 a gallon. And that, for some families, that's $1,000 a year that now they're spending that they weren't spending before on, something they just need to get to work or to do their errands. These aren't, discretionary trips that are getting squeezed. And even something as simple as a gallon of milk went up by a whole dollar from $3.25 to $4.25. And that's just one example of many goods. And so that grocery bill just starts going up. And so for families, working families, especially, I'm thinking about people who are making less than $50,000 a year or people who are on fixed incomes. This increase in the inflation, and particularly among inflation for things like gas and groceries, really creates a squeeze. And so the gas, the groceries, the rent, utilities, all those things take up more and more of their budget. And that leaves less for everything else. And it's stressful. And, people seem to be seeing that and saying that and when we talk to them in surveys. So let's go to the next slide. This is the New York Fed does these surveys where they ask about consumers' expectations about where they are and where they see themselves financially in the next year. And they've used, different versions of this question over time. But we can see no big surprise. In March of 2020, people were feeling pretty negative. And in April, they were even more negative. In May, they were pretty negative. And then they started to get a little better. And, they never really quite got back to their 2019 levels. But, basically people felt pretty good. But then we started to see this climb in people feeling that they're worse off financially. They're going to be somewhat or much worse off financially next year. And, now it's almost half. It's about 45% of families are saying that they're going to feel, somewhat or much worse off financially in the next year. And so this is data this released this week, actually. So as of June. So, there's a lot of pessimism right now among families and among consumers. I'm just go to the next slide. Go to the next slide. Sorry. So the other thing I want to bring out too is this has somewhat to do with what people think prices are going to do. So what you've heard so far is discussion about what prices have actually done. And certainly the Fed and the economic stimulus and those kinds of things, all these monetary phenomena all certainly affect inflation, but also people's perception of what prices are going to do matter too. That's what pushes them to charge more or to ask for more in their wages or whatever else. And we can see in the data that the light blue line here is people with incomes under $50,000, and their inflation expectations are in general above those making 50 to 100K, which is that sort of darker blue, or the orange line, which is people making over $100,000. So again, this, the lower income folks are feeling this more, and they're feeling like not only are they getting squeezed now, but they're going to be more squeezed in the future. And so I think that sort of leads into this sort of pessimism that families are feeling about where inflation is. And, for families, this is, unlike unemployment, where it's like, geez, I really feel like I should get a job. There's nothing you can do about inflation. It just feels like this overwhelming thing. You've sort of lost power over your consumption. Next slide. And the other thing, we can see this too when people talk about how much they think their household spending is going to grow. So sometimes we see this as a marker of, perhaps people are planning ahead towards some big purchase or something like that. But this is really just people saying that I'm going to be spending more and more on some basic stuff. And again, that's the light blue line is that under 50,000 income group. And they're the ones who are saying that they expect their household spending to grow by over 9%. And we're not seeing any indication that wages are going to grow by 9%. So, in real terms, people are going to have less money. Even if they are getting some raises, it's not going to be enough to offset what they think their spending growths are going to be. And this is going to especially hit lower income, fixed income families and working families. Next slide. So all that said, if we look at another question, again, all these questions are coming from the Federal Reserve Bank of New York and their survey of consumer expectations. They ask a question about whether consumers feel like they're going to be able to keep up with their minimum debt payments over the next 3 months. And again, you can see a spike, especially among that light blue line, the under $50,000 group in 2020. We saw that. We've talked a lot about the problems that families were facing as the pandemic came on. There was a large effort in the stimulus and other pandemic assistance that came out and largely avoided the problems that we could have had with defaults. But even now, again, the light blue line or the lowest income group, they're still about where they were in 2019. So even though there's some pessimism about the squeezing of budgets with rising prices, we don't see this sort of pressure in terms of people's ability to manage their debt. Their debt service seems like something they think they can continue to manage. And we always are going to see this difference by income. It's always going to be harder for lower income people to manage debt. But as of now, it isn't looking like we're getting that pressure. So I think there is a little bit of a positive, or at least a less negative side of what's going on. We're not seeing that pressure. And we're not really seeing it in the credit data either. We're not seeing a rise in delinquencies. Next slide. All right, so thinking about what's next, what are we going to see consumers doing? These are probably some of the things that you all are doing too. Certainly, we're seeing more people shopping around. We're not seeing people moving as quickly to make purchases, especially larger purchases, or they're delaying discretionary items, things that they don't have to necessarily purchase now, and actually, not buying stuff that maybe they were buying a lot of during the pandemic, household items, that kind of thing. A little more attention to bulk or deals or specials. I'm reminded today is Prime Day, so maybe that's one of those things that people are looking for. Bulk can be a way to have a lower per unit cost if you can store what you have, but for lower income or fixed income households, they may not have that larger price. So to be able to buy the $30 pack may be harder for them than to buy 3 of the $12 packs, and so they lose out on that bulk deal. And then we see substitution. This is where people buy frozen instead of fresh. They buy the store brand instead of the name brand. So those substitutions that consumers are doing, and we're starting to see that in the data already, in the retail data, people shifting from one kind of consumption to another. And again, we're squeezing this balloon of people's budgets with these higher prices, and so something's got to give. And so it'll oftentimes be in those kinds of ways. The other thing we haven't talked a whole lot about, but interest rates are going up, and they're going up most rapidly for consumer credit. And so credit cards are a good example. Anybody who's on any kind of adjustable rate mortgage or a credit card with adjustable rate or any loan with adjustable rate is seeing higher and higher interest rates. And that's going to result in, less demand certainly for credit. And for people who have credit, they're going to spend more of their income trying to keep up with those interest payments. But I do want to say too, there is some concern, I think, of those of us who are watching credit markets and consumer watching the sort of credit report data that's out there, is that one way that people can get by when things get more expensive is to use their credit card more. So, charge my groceries. Maybe I'll get a chance to pay it off at the end of the month, and maybe I won't. Maybe I'll roll it over. Well, I just told you interest rates are going up, so the cost of doing that are going to get higher and higher. So that's a caution to be worried about. If people try to stretch their budgets, again, squeezing this balloon, and the way they try to get by is using consumer credit to get by, that's a concern. And so we're going to have to keep an eye on that. And certainly not something we counsel anybody to do, avoiding to use credit for basic expenses at all costs. The other thing we're starting to see is there was a huge run up in savings during the pandemic. People weren't spending, they were getting stimulus and other kind of money, they were banking it, and that savings is being spent down, especially for lower income households. And then the caution I have is, as somebody, I study retirement and disability issues a lot, and look at people's savings and retirement savings and their precautionary savings. All those things are ways to get by, certainly in the short run, but in the long run, this is expensive. Just like in the long run, having high cost credit is expensive. In the long run, not contributing to your savings, not putting money away for retirement or college savings or whatever it might be, those really can be a detriment. And in fact, if we think about this as a value proposition right now, the prices are low. This is a good time to be investing in those long run savings. So, we do want to keep an eye on this, making sure that savings rates don't dip too low, and, really discouraging people who might be having second thoughts about, well, I can make my budget stretch further if I put less money into my retirement savings or even take out some of my money from retirement. We really want to try to keep people to be focused on the long run budget at the same time they're trying to make end meets. So, so far I think things are okay, but we're going to have to keep an eye on this. And I hope what's happening with the Fed, and I hope those actions are going to bring prices under control. And again, I think from a policy perspective, we're just going to have to keep an eye on how families manage all this, and particularly if we're entering a new recession.
Michael, you put a fairly moderately okay spin on this, at least. So thank you for that. Maybe the bottom isn't falling out. It's very hard to figure out what's going on because unemployment is at historic lows. And so for people to say, we're in a recession, it feels odd. So we've got a ton of great audience questions. I'm going to try to work through them fairly quickly so I get to a number of them. I'm going to start by asking Kim something that I think came from Tammy Olson in the live chat. And she was kind of wondering, what's with the older, the early retirees that we heard about? That was a big part of the decline in the labor force. Obviously, the savings that they had probably not worth as much today. And certainly, if you're still working now, the idea of early retirement is quite a bit less appealing. So do you expect to see the labor force heal in particular with the older labor force participants? And what about younger labor force participants? What's going on? Where'd the workers go?
So if you look at labor force participation rates broken out by age, you'll find that the kind of prime age workers or kind of middle-aged people have just about returned to their pre-pandemic level. So labor markets in terms of people between 25 and 55 or something like that are starting to look pretty normal. When you look at the younger and the older demographics, they're still quite a bit lower than they were before the pandemic. On the older side, part of that is again just baby boomers. It's demographics. It's something that we know is happening. Just a bigger chunk of the population is getting older and does want to work less. But I think you touched on the big things, which are people's retirement savings just fell a lot. They grew a lot. And I think a lot of people looked at that and said, hey, I'm 20% richer than I was before. Maybe I can retire a year earlier or 2 years earlier. And now a lot of that's gone. So it will be interesting to see if we do see labor force participation come back. It doesn't seem to be doing it right now. So, but again, it's only been, a few months. And so these things can move kind of slowly. On the young end, I don't have a clear view of what's going on there. Labor force participation rates are still down quite a bit. It could just be that people are spending more time looking for jobs. If one of the things that just naturally comes out of most economic models you write down is that if it's easy to get a job, I'm going to spend more time looking for exactly the right job that I want, and that means I'm going to spend less. I'm going to spend more time being unemployed or more time kind of searching. So that I can find exactly the job that kind of fits me best. And that could be part of what's going on as well. All those problems are the sorts of things, though, that a recession, particularly a tough recession, will fix. And maybe not in a way that's pleasant, but that's sort of my thought about kind of renormalization of the labor market. And part of this, maybe the last thing I'll say is just that, as you kind of pointed out, and Michael pointed out, and Paul pointed out, there's kind of a weird sort of recession if we're in one right now. It doesn't feel so bad right now. Employment is doing kind of well. And to be fair, the last 2 years have been very weird expansions and recessions, right? These are not the normal business cycles that we're used to, where prices kind of carry information and signals, and businesses are making optimal decisions about whether to hire a worker or not, to be open or not open. We started this thing off with the government stepping in and saying, okay, all of you guys go home. Whether or not you think your business is a good business or not, go away. And then we'll decide, sort of when you can open back up again. And so that, I think, has caused a lot of weird sort of dynamics in terms of the usual signals that tell people go back to work or don't go back to work, start a business, don't start a business, and how to set prices. And so, yeah, to some extent, it's hard to say kind of what's going to happen next just by looking at what's happened in the past.
Couldn't agree more. This does not feel like, to me, the 70s and 80s inflation, which really had its origins in momentum that was building at the end of the 60s with an overextended economy, and that continued. And then you had an oil price shock, right? And repeatedly. This was more sudden, and it felt more like a wartime economy in a way. Obviously not a war until recently in Eastern Europe, but it had more of those dynamics where all of a sudden the war is over, the equivalent being now vaccines are available, and that's when prices shot through the roof. So it still feels a lot like a supply phenomenon to me. And one of our questions from Steve Goldstein is, are there any government policies that can really address the supply side? So you said the Fed can only affect the demand side, but what about the rest of government? Are there policy changes we can make? And I'd look at, Michael or Kim to chime in first. I'll get to you next, Paul. What do you think we could do to make things better on the supply side?
I'll let Michael go. I feel like I was talking too much.
Yeah, I think there are limited tools available. I mean, if we're worried about things like equity, and we're worried about things like food insecurity, and we're worried about what the effects of inflation on low-income families, then we have subsidies for things like food or housing. But in terms of supply side, I can't imagine that we would have policies right now that would provide any supports for the supply side.
How about zero tariffs? And the stronger dollar, won't those help?
Yeah, and a solid infrastructure, and I think we've got some other, supply chain issues to work out.
Yeah, if I can jump in for 1 second. Yeah, so I think one of the things, I think Michael's right, that the things that government can do are not things that are going to fix anything anytime soon. You want to talk about, infrastructure investment, you want to talk about, ways to, kind of help firms build better supply chains. Those are all things that take a long time. Typically, some of the things that just can't be helped. One of the big supply chain issues was, if you remember the big storm in Texas a year and a half ago, turns out a lot of industrial materials come out of BASF type plants in Texas, and those things went down and took a very long time to come back. Resins and polymers and industrial foams, things like that. And there's not a whole lot the government can do. I think the worry would be the government starts to try to do, again, going back to the late 70s, early 80s discussion, the government starts trying to get into the game of setting prices. We've already seen maybe some not great remarks by the president, sort of talking about how gas station owners should or shouldn't be pricing gasoline. Government price controls are almost never the solution. And the worry would be maybe more that the government tries some policies that we kind of know tend not to work, both in terms of actually decreasing inflation, but also creating a bunch of other problems, particularly for small businesses and for people who are working.
All right, Paul Leff, a couple of investor questions. First, and I think this was Tammy Olson, wonders, how do CEO personalities affect your evaluation of a stock?
Well, I kind of live by what a creed of Warren Buffett when it comes to CEOs, which is you should be interested in a company and assume it's going to be run by an idiot, because someday it will be. I recognize there's tremendous talent in certain CEOs that have done an unbelievable job. I don't think I can pick those out from a pool of companies that I'd be interested in when the CEOs are not really very well known. So I'm just interested in buying assets that are really cheap. I just don't believe I can differentiate very well.
That is very well said. I'm going to remember that. Mark Schmidt wonders, and I think this is a good question for you, Paul. The Fed's been talking a lot about raising interest rates, and they're also committed supposedly to shrinking the balance sheet, which I will admit I'm not entirely clear why that is absolutely necessary. But when the Fed does shrink the balance sheet, which is effectively selling a bunch of the assets they've acquired over the last decade, and there's a lot of them, who's going to buy those assets, and what are the implications of that going to be for asset prices? And is there more bleeding to be done here?
Well, I only think they will sell these assets if there is a willing buyer. If the markets become difficult, I mean, the Fed holds the most liquid assets in the world. They hold treasury bonds and treasury bills and highly liquid mortgage product. So I just don't believe they will disrupt those markets. But if they can sell those assets, and the buyers of those assets could be international, it could be international buyers. There's lots of domestic buyers, lots of banks that buy those kind of assets. But if those, we can't have a market where those securities become untethered. It's just way too chaotic.
Understood. Charles Weiss wondered earlier in the program, who is harmed the most by inflation? And I'll throw that over to Michael.
Yeah, I mean, it's anybody who's the larger the proportion of your budget is going towards these fixed expenses like gas and groceries, fuel, utilities. They're the ones who are going to have to make some tough choices about some of those necessities and some of those things that really affects. I mean, and it's stressful too. I don't want to dismiss that, but I think that's really the group that is hardest hit. So people on fixed incomes and people who are low income. And we haven't talked much about housing, but there's a lot of pressure on housing prices too, and that's probably not going to subside anytime soon. And that's going to again continue to just squeeze this balloon for the budgets of these lower income families or fixed income families.
Well, we are coming up on the top of the hour. Paul, I'm going to ask you a final question. Now that equity markets have sold off by 20%-ish, what's your long-term expected return for someone who's holding, say, a 70% equity or 60% equity and 30-40% bond portfolio, kind of the generic retirement portfolio? What am I going to get over the next decade? 6%?
Well, you're going to get more than you got last year if you were to have bought. So that's the good news. Both you're getting a higher return on your fixed income portion, and you're getting probably a higher future return by buying the S&P down 20% than you were if you had bought it at the top. That's the good news. I think it's just going to be a very tough slog if you just hold the S&P 500 index and you hold treasuries. My expectation is over a very long period of time, you'll get 4 to 6%. Over the short run, I just think it's just a really tough call. It'll be very volatile. We've had periods of time in our history where for 10 years you get no return or very little return. For 20 years you've had, like, mark from the mid 1960s to 1982, that was a period where you got very little to no return. So it's possible we could have a very long period of very low returns. But we're in we live in a great country, and there's a lot of great things that happen in our country, and hopefully the excess gets flushed out. Some of the companies that got funded will get flushed out, and new ones will take their place. And the vibrancy of our financial markets, as long as they stay vibrant, you have to be opportunistic. You have to pick and choose your spots and find securities that you think you can make a good return without risking a lot. So I don't think the S&P 500 returns will be that exciting, but and it'll be volatile. So just strap in for a wild ride.
Well, thank you all. This was a really informative program. I'll second what you said, Paul. I mean, the U.S. economy is still a very dynamic place. There's no other major market that has, the preponderance of, the top 10 most valuable companies in the United States were all founded after 1975. That just isn't true in many places around the world. And I think that will only continue. I think there are still a lot of very disruptive trends out there, and there will be exciting new companies born that address the moment that we're in, whether it's decarbonization or digitization. you name it. So I think there's still more good ahead, but hopefully we can resolve some of the geopolitical tensions and get back to a little bit less stressful day in, day out life. But thank you all for joining us tonight. Really great program, great insights, and I'll have you all back again soon, I'm sure.
Thanks, Mike.
Thank you.
And thanks to our audience for joining us tonight. We'll be back again on August 2nd when we intend to have another session on the Ukraine crisis and where we're at today and what we can look toward in the future, and also the humanitarian response to that crisis. Thanks for joining us. Hope you have a great Tuesday summer evening, and we'll see you all again very soon on Wisconsin.
You can try, but you'll never stop a Badger. Because we Badgers are born with curious minds and endless heart. When we see a curve in the road, we speed up. When there are mask shortages for first responders, we make our own supply chain. When there's a world on pause, we sharpen our claws. Through thunder, fire, and pandemics, we'll keep going. Because after all, you can't stop a Badger.